Good morning, everyone. This is Marshall Gidler bringing you the morning comment for March 10th. Yesterday was the first day for the ECB's quantitative easing program. While one might have thought it was fully priced in by now, in fact, German 10-year yields collapsed by 8 basis points to 0.31%, a huge move considering how low they are already. The big move in bonds suggests that the quantitative easing wasn't totally priced into the bond markets, which means it may not have been totally priced into the FX market either. That suggests the euro can still fall further. Meanwhile, the Greek situation is heating up again. Apparently, the creditor group wasn't impressed with Greece's reform proposals, which it called amateurish, and said they don't signal substantial progress to meeting the country's commitments. Greece is apparently still short some 1 billion euros for March. Note, though, that the yield spread between treasuries and bunds is now at a record-wide level. So, the quantitative easing is further compressing the risk premium in European bond yields, even while the risk in the Eurozone remains acute. This is not a good combination for the currency. The New Zealand dollar fell sharply as trading in dairy futures and options and shares in dairy companies were halted. The police are investigating a criminal threat to poison infant formula unless the country stops using a certain pesticide. This will cause huge damage to the world's biggest dairy exporter. Now, no trace of the poison was found. Nonetheless, the threat could weigh on the New Zealand dollar until it's resolved. Meanwhile, though, the Australian dollar was down even more than the New Zealand dollar compared to yesterday's European opening, after the National Australia Bank Business Confidence Index for February fell. Today's highlights, we have a relatively light day today as regards indicators. During the European session, the French industrial production for January is expected to fall, a turnaround from the previous month. In Norway, the CPI is forecast to have accelerated in February, probably due to the fact that the effect of lower oil prices is gradually fading. This could support the krone temporarily as the market tries to anticipate the result of the Norges Bank monetary policy meeting on March 19th. In the U.S., the National Federation of Independent Businesses Small Business Optimism Survey for February is expected to have increased a bit. This is important because small businesses employ the majority of people in the U.S. Meanwhile, the Job Opening and Labor Turnover Survey for January is forecast to show that the number of job openings has increased marginally. The market will also be watching for the quit rate, which Fed Chair Janet Yellen recently singled out as, quote, a barometer of worker confidence in labor market opportunities, unquote. Following last week's strong employment data, this is likely to keep the dollar supported. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.